Anyway, so that's really what's happening when it comes to housing. And getting back into the growth, we've seen the year over year growth in housing all the way back since 2012. Like I said, 2012 was truly the bottom of the market. If you guys can see here, this is the slowdown from 2008 all the way down to 2012. It was the slowest timing in the real estate market. These were the dark years 2011, 2012 in real estate, because there was no money. It was very difficult. There was blood in the streets, but only those that had ability to purchase were able to purchase. And I can tell you, we bought some of our best projects in those years that we still have. So now, what is happening? Well, yeah, we can see year over year growth. Now, this doesn't mean that we're at the top of the market. This only means that we have seen a growth in patterns of real estate prices going up and up and up, right? So this doesn't mean that we're at the tip yet. It only means that the percentage of housing markets that have grown year over year will continue to grow. Okay, and this is as of December 2016, and I think we're still gonna continue seeing the same trends. When it comes to mortgages, like I said, financial innovation is really key. I really look at financial innovation. Interest rates do have an impact, but the financial innovation is more of an impact when it comes to housing. And the reason is very simple. Uh, I'll tell you, if you have a 7% interest rate, an 8% interest rate, but you can get into a house with less down payment and easier requirements, consumers will jump over that instead of having a 4.75 interest rate on an FHA loan with a list of 150 requirements that will probably fall apart on the 89th day of your transaction, out of the 90 days that it will take to close it, and then basically get the loan declined at the 11th hour. So all of that has happened with consumer lending. FHA loans and conventional loans are still very strict, and the reason is because Wall Street is and the government, Fannie Mae, Freddie Mac, are still buying these mortgages and these securities. So they still haven't fully forgotten what has happened in the past. So rates are not as important as financial creativity. Now, that's not to say the rates are not important. Yes, they're important, but people were buying houses left and right when the rates were double digits in the 90s. I remember one of my uncles bought a really nice house. It was like $500,000 at the time, and rates I think were like 14%. And but again, rates represent an impact to your affordability. For example, 1% increase in rates will impact your purchasing power by 10%. So what that means is, if today I'm buying a house for 300,000 and I wait a week and my rate goes up by 1 point, now that represents a 10% shortage on my purchasing power. It is pretty much the same as if I was to buy a $330,000 mortgage with the rate that I was getting today. So that 1% increase is 10% increase or decrease to my purchasing power. So it is pretty significant. But most people will say, I'll rather just pay that extra right now if I can afford it, as long as I can get into the house price, lock in my house price, and later on refinancing. But the reality is people cannot participate because the financial innovation is not all there. If you were to talk to anybody and ask them, hey, if you could get into a mortgage at 8% with very little down payment, would you do it? I can guarantee you that everybody will tell you yes. Uh, it is risky, but what I'm trying to explain is that the biggest impact is really the things that are not rational. And although sometimes um, um, being creative may be positive for the industry, this creativity creates the irrational market that will ultimately create the same conditions for the boom and bust that we've seen in the past.